Hello folks, and welcome back to this mini-series on banking law. In the previous presentation, we finished off the whole banker-customer relationship and the theory surrounding the economic models with the monetary policy in particular, and the difference between that and reality, given the fact that banks create credit, and that's responsible for 97% of the money supply, which obviously exposes the whole subterfuge, being spun in the media and within academia of where to lead people's belief of how banks operate in regards to a depository institution which lends out reserves and other people's deposits, and a little bit of fractional reserve banking, which only applies to 3% of the creation of new money in the money supply, whereas obviously 97% is done through this process of creating credit on account of zero balance. And so the whole reason why they do what they do is purely for population control. And there was a wonderful saying that I got from a mini presentation that's under my resource tab at my website by David Harvey. Okay, I think it's titled Crisis of Capitalism, where he states debt incumbent households don't go on strike. Okay, so that's one of the main motivating factors for this mechanism and technology is to ensure that people are constantly in debt servitude, right? And just got one other note before we move forward under accounts in the next chapter. Off-ledger, so referring to this off-ledger activity that I was referring to in the previous video, it obviously ends up in our accounts, right, to spend on, whatever it is we took that loan out for, whether it's to buy a house or a car or personal loan to spend on whatever, to acquire assets, etc. Okay, but the off-ledger activity refers to how they reclassify the accounts payable, and otherwise how they then get the books to show the funds come from somewhere else. Okay, and that's the whole reason behind, like I showed you with the NOHC, non-banking group, banking group, with the companies, the trust accounts, and all these subsidiaries, that they can certainly move things around. So we're going to watch two presentations that are going to help us understand more of that explanation and that concept, okay, in order to hopefully hit that home for us and to study and to fully understand where I'm coming from when I'm kind of explaining that and what other people are saying, obviously, when they come into this knowledge. Okay, so we've got two presentations we're going to watch, and then we're going to go through the rest of the notes, which is not going to be anywhere near as long as the first presentation, but it's going to be very hard hitting with a lot of gems again, okay, under accounts. All right, so let's go full screen and play this. This is otherwise on my YouTube, link to Richard A. Werner's paper.
Three theories of banking, competing against each other for over the past century and a half. The credit creation theory, the fractional reserve theory, and the financial intermediation theory. In 2014, Werner produced the first ever empirical study in the 5,000-year history of banking, and it proved that the credit creation theory is correct. So let's look deeper into this theory and how banks create credit or money out of thin air. According to the credit creation theory, banks individually create credit out of nothing whenever they issue a loan. When a loan is granted by a bank, they purchase a loan contract. Legally, this is considered a promissory note, issued by the borrower of the bank. This is reflected by an increase in the bank's assets by the amount of the loan. The borrower receives the money when the bank credits the borrower's account. And through this process of credit creation, 97% of the money supply is actually created out of nothing. It is purely fictitious. As Werner said in 2005, bank credit creation does not channel existing money to new users. It newly creates money that did not exist beforehand and channels it to some use. So how do banks actually create this money out of thin air, and what makes them special to other firms? Why are non-banks unable to do this? To explain, let's compare the accounting of a loan when extended by a non-financial corporation, such as a manufacturer to a supplier, a non-bank financial institution, such as a stockbroker extending a margin loan to a client, and a bank lending money to a small business. In the UK, any firm or individual can actually grant a loan. It is not a regulated activity. So how are banks different to these non-bank financial institutions and non-financial corporations such as a manufacturer? As you'll know, all firms have a balance sheet. This consists of assets, liabilities, and shareholders' equity at a specific point in time. Let's start with the manufacturer giving a loan of 10 million to its supplier. When the manufacturer grants the loan, it is purchasing a loan contract, or more specifically, a promissory note, as we discussed earlier. This appears in the manufacturer's balance sheet as an increase in assets. This increase in assets is actually the manufacturer's claim on the debtor. Well, what is this claim? This is the supplier's promise to repay the loan to the manufacturer. At the exact same time, the manufacturer has an increase on the liability side as an accounts payable. The supplier is due to be paid as per the agreement. When the manufacturer disperses the loan, it is drawing down its cash reserves and it now no longer needs to pay the supplier, so accounts payable disappears. As a result, one gross asset increase is matched by an equally sized gross asset decrease, leaving net total assets unchanged. What's left on the balance sheet is simply the loan contract. The cash reserves have been drawn down and the accounts payable has disappeared. Next, let's look at the stockbroker engaging in margin lending. So this is a non-bank financial institution. The stockbroker again purchases a promissory note, a claim on the client who is borrowing the funds, the promise by the client to repay the funds at a future date. This increases the total assets. At the same time, there is an increase in accounts payable as a client is due to be paid. The disbursement of a loan, for example by transferring cash to the client, lowers the cash on the asset side while simultaneously reducing accounts payable as a firm discharges its obligation to pay the borrower. In the end, both total assets and liabilities remain unchanged. The only visible change is the category of assets on the balance sheet. We now have a loan contract there. As you can see, for both the non-bank financial corporation and the non-financial corporation such as a manufacturer, the balance sheet total is not affected by the granting and disbursement of a loan. However, this is not the same in the case of a bank, which has a banking license. To understand the difference, it is important to disaggregate the lending process into two steps. First, step 1, the balance sheet upon purchasing the promissory note and having an accounts payable. And step 2, when the loan funds are paid out and accounts payable disappears. In step 1, the situation looks pretty much the same. The bank purchases a promissory note from a borrower and the asset side of the bank's balance sheet increases by £10 million. On the liability side, accounts payable also increases by £10 million as the bank owes the borrower funds. The accounting is identical for all three types of lenders. This means whatever makes banks special must appear in step 2. Banks behave very differently when the bank must provide the funds to the borrower. Instead of needing to make funds available to the borrower by drawing down cash, as needed in the other two cases, a bank doesn't have to give up anything to pay out the loan. There is no requirement to draw down on cash reserves. So how is it then that the borrower believes that the bank's obligation to pay them has been met? Well, this is done through a very powerful accounting change that takes place on the liability side during step 2. The bank does reduce its accounts payable by 10 million, but at the exact same time, it increases deposits on the liability side. It reclassifies accounts payable as deposits. Well, why is this and what actually is a deposit? Although it might surprise you, you do not own the funds in your bank account. You have not deposited your funds and the bank is certainly not holding them on your behalf. In fact, a deposit is a loan to the bank, a liability and an obligation for the bank to pay back the lender. It is a record of debt to the public. Therefore, it has reclassified accounts payable to another category of liability, namely a deposit. The bank no longer needs to pay an account. The bank just simply owes you the money. No transfer of funds has actually taken place from one person's account to the borrower's account. Although the small business has the impression that the bank has transferred money from its capital, reserves, or someone else's account to the small business account, it has not. Neither the bank nor the small business has deposited any money. In step 1, the bank had a liability to pay an account. The law states the most common way to be discharged from liability is through payment. But no payment has taken place in step 2. So the bank's balance sheet remains stuck in step 1, and the balance sheet has lengthened. The bank's liability has simply been renamed as bank deposit. Bank deposits are defined by central banks as being part of the official money supply. So if bank deposits are increasing, the money supply is increasing. Therefore, whenever a bank grants a loan, they invent fictitious customer deposits, which all users of our monetary system consider to be money, indistinguishable from real deposits. Thus, banks do not just grant credit, they create it. They create money out of thin air. Banks are thought of as deposit-taking institutions that then lend out. Well, as you now know, banks do not take deposits and banks do not lend money. Now let's consider what happens when the customer of the bank, the small business, wants to pay the supplier using the newly created money. Now in a one-bank system, or where the bank is sufficiently large enough that both the small business and their supplier's account are both held at the same bank, the deposit amount doesn't change. Although the amount doesn't change, who it's owed to does. The bank no longer owes the money to the small business, but it owes it instead to the small business supplier. If, however, the supplier holds an account at another bank, the small business bank deposits are going to fall, and with it an asset class, for example cash. At the same time, deposits at the supplier's bank will increase, and again an asset class will increase with it. Overall, credit has still been created. So although we're aware of the accounting that allows banks to create credit, what is it that actually allows the accounting to take place? In the UK, the so-called client money rules require all firms that hold client money to segregate such money in accounts that keep them separate from the assets or liabilities of the firm itself. A firm, on receiving any client money, must promptly place this money into one or more accounts opened with any of the following: a central bank, a CRD credit institution, a bank authorized in a third country, or a qualifying money market fund. Neither the manufacturer or the stockbroker used in our earlier examples have a banking authorization, meaning client deposits must be held in segregated accounts with banks or money market funds. This means the client assets always remain off balance sheet. The depositor always remains the legal owner of those funds. However, things are different if one has a banking license. The client money chapter does not apply to a depository when acting as such. So therefore, what actually enables banks to create money is their exemption from the client money rules. As Werner said in 2014, banks do not have to segregate client accounts and thus are able to engage in an exercise of relabeling and mixing different liabilities.
Have you ever wondered?
So yeah, quite interesting. And otherwise, re-emphasizing what we've already covered. And I'm just going to play this, which goes a little bit deeper, might offer even more insight, which is from a CPA out of Winston Trout's Disc 6 in Kelowna seminar. Okay, so hopefully after these two, just obviously going back over this concept is probably enough to know what we need to know in order to get ourselves out of situations of those who may be on the death pledge, serving some kind of debt obligation. You certainly have enough tools now, knowledge to renegotiate that and find and seek remedy, as well as start having some interesting conversations with certain individuals at the bank, the banker, CEO, and even the treasury. As trustee, as we'll see, we'll get into the importance of an account being known as a trust account and what that does to the banker and his duty of care over you as a customer in regards to a constructive trust, which can extend to the trustee duty to the banker, where you're now the beneficiary, entitled to certain privileges and benefits that wouldn't be afforded to you if it was just a simple banker-customer relationship. Okay, so let's play this, and we'll go over those notes.
Kaz of the Christian family. Did I spell it wrong? Anyways, it's much longer than that, but that's precise, concise, to the point. So everybody just calls me Kaz, but I'm not Japanese. Apparently there's a lot of Kazes in Japan. I got into the game of accounting when I used to work for national revenue taxation back in 1972 to 74, and I went into accounting in 74 and graduated as a CGA, or Certified General Accountant, in 1979. And I've been in private practice in Winnipeg and here in Kelowna ever since. It was in the year 2000 that I tendered my resignation with the CGA for a number of reasons, but one, of course, which is ethical. And it was prior to that that I had learned that the Income Tax Act of Canada was unconstitutional, and there's no act that says a human being should be paying any taxes. That was from David Butterfield and his Shareholders of Canada, so I went that particular route. And so I learned a lot over the years, and I've done my share of suffering at the hands of CRA, which I'm still doing now. But with the information this weekend, I think I'm pretty confident that I can sort of overcome that. And I'm going to have a lot more fun, because the more knowledge you have, the more experience, and the more falls that you've made and you pull yourself back up again and keep going, the easier it becomes, and the less stressed you are when you're met with some opposition that come around saying that there's some kind of an authority. But all I wanted to do was to clarify a couple things in regards to accounting. Now, once upon a time, prior to the Renaissance, if I can remember some of my history that I learned a long time ago, there was no such thing as double entry bookkeeping system. That's really what Winston has been talking about. He's called it accrual accounting, and I'll show you the difference. It doesn't matter what word you use, except that when you're dealing with some technical language, you should use it properly, because it can be confusing. But back then they only had single entry bookkeeping system. So in one of the Italian states, or independent states at that time, it could have been through the Medicis, who knows, they came up with this idea of a double entry bookkeeping system. And all that means is that for every, what we call a debit, actually it should be DB, maybe this pen doesn't write as dark as the other one. A debit and a credit. Look at this as a cross. If you want to, you know, Winston pointed out on Friday, I wasn't here yesterday, when you're looking at John the Baptist as this particular dividing line, and Jesus is here, who died for your sins and taught you the Lord's Prayer, which said, forgive me my debts as I forgive my debtors. A lot of religious organizations have transferred that to trespasses versus my trespassors, but it's really debt and debtors. And here the debit system, if you want, is the Mosaic law. You have Jesus' law, which is mercy. This is execution of law. This is, in fact, mercy of law. But look at this as a debit and credit system. So, as Winston said, for every entry you put on this side, whatever it happens to be, it could be things like accounts receivable. It's just basic bookkeeping. I just want to make sure you understand that. Or cash in a bank, or it could be inventory, or it could be a truck, which would be a depreciable asset. So if you're going to have an account receivable here, you have to have a balancing entry somewhere. It just can't hang there in the middle of nowhere. On the credit side, you could have an account payable. It usually doesn't happen that way, but it's a balancing entry. From a bookkeeping point of view, this is perfectly legitimate. It may not be accurate, but it's legitimate because it's balanced. Or you could have an account receivable. Well, this would be easier. We've got $10 cash in the bank. Now, either this was a contribution by an owner, so it's a contribution of $5, and maybe you borrowed some $5 or $4 and another $1 from somebody else. So 5 and 5, the bottom line, have to match. Or you could have earned over here, which is also on the credit side, but a little further, and it's also split in two, and that's called the income statement. Okay? That's what we call it, but it doesn't matter. Profit and loss is an old term that was used for many years. We now call it an income statement. And here again we have credit. Here are all your expenses, no matter what kind, and here's your revenue. If your expenses are 1, and they could have come from any combination here, but I'm not trying to make a direct bookkeeping entry for every little bit. But if your expenses are 1 and your revenue is 11, you end up with a balance. In other words, you need 10 more units of expenses to match your revenue. So here's your profit. It's 10, right? Because you got 11 minus 1, you got a 10 profit. So down here, your cash could have come from your profit, and that's really part of what they call equity. It's your contribution and your profit. And you have 10. So again, you got to balance. And within this particular system, from a banker's point of view, this is a beautiful system to manipulate figures. All right? So let's just go to what a bank might do when you go in there to borrow some money. And it's all ledger accounting. It's always been that way. And you can create anything because all it is electronic or paper entry. When you go in a bank and you make a deposit, right? This is where a lot of people get confused. Why does the bank say that I have a credit? I have a credit in the bank. Well, that's because they owe it to you. So here's the bank. It has a liability to you of $10 because in your bookkeeping system at home, which is you have a $10 account receivable, which is an asset. Okay, and these are liabilities. So the bank says, well, you deposited $10 in your account. Therefore, we, the bank, have a liability to you. We owe you this money. And you on your passbook or your bookkeeping system, you say, I have a debit, an asset of $10, because I can collect this from the bank. Are there any questions so far? Fairly straightforward. So when you go into the bank and you want to borrow money, the bank doesn't have to give you cash, right? At least not normally. And this will be bank 2. Say there are only 2 banks in town. You have a checking account at this bank and you want to borrow from this bank for your house. So what does the bank do? Well, it has to balance its ledger. Internally, it has to balance its ledger. So what it does is it, under asset, it gets your promissory note. You sign a promissory note, and you have to sign it before they advance you any funds. Not after, but before. And there are some technical reasons for doing that. I mean, why would I lend you some money if you didn't sign me a promissory note, right? But should you sign the promissory note after I lent you the money or before? Well, they can't give you anything until you've signed a promissory note because they take the promissory note and they monetize it. So in their accounting system, they say, we have, in effect, an asset. We've got this bond, this promissory note, and it's for $100,000. Now, how are they going to balance that? What do they have to do? They have to create a liability, so now they have, in effect, an account payable of $100,000. Now, if you don't have an account at this bank, they still have a liability. Where does that liability, well, to whom is that liability? No? No, you're buying a house. No? We're not getting there yet. We have an intermediary. No, you're getting there. You know, they're the lawyer, right? They owe it to the lawyer. It has to go to the lawyer's trust account. You cannot effect this unless you go through a lawyer. So the account payable to lawyer. Pardon me? No, this is going on film, and this is going to CSIS. There are those who think that I'm an agent for CSIS, and I want to make sure that the information that goes to CSIS is correct. So they're not lawyers. I mean, thieves. They're liars. Okay? If you're from down under, you know how to pronounce this very well. Liars. So the lawyer gets his and he's sort of the agent, if you want, and he's got his trust account. And he says, okay, I've got a receivable in my trust account of $100,000. But he doesn't get it at the same time as this is created. This is created first on ledger, and then this is wiped out by shifting it over to him. He then shifts it over to his liability part, which is actually his bank, when he gives you a check, or maybe goes to the vendor of the property. He gets the check, and he goes to bank number 2. And what happens there? We now has this check, right, which is a negotiable instrument, and he deposits $100,000. And And now the bank has a liability to him of $100,000. That's to the customer. So when you have gone over here, this money disappears, ends up in customer number 2. This is all from a technical point of view. This has nothing to do whether it's right or wrong or indifferent. From a technical point of view, that's how it moves. Now, since you drew against this liability to you through your agent, the lawyer, has gone over to the customer, the bank has performed its duty on ledger, shifted the ledger over to somewhere else, has performed its duty to you, its liability, because you've given it authorization by the promissory note, which is not a separate instrument anymore, because I checked that out with the bank a few years back. It's part of your mortgage document. It's buried in there. It's not a separate, here's a promissory note. So that entire document, in effect, is a promissory note, and you promise to fulfill your obligations under that particular promissory note. If you look at Winston's promissory note of earlier this morning, it went on for several pages. Well, the bank does the same thing, only gives you 20 pages, fine print. And the only obligation it has is to take this money and push it over there. The rest of it, all your obligations to the bank, which pertain to repaying this $100,000 at interest rate of 6% per year or whatever. There's your double entry bookkeeping system. This is how the system has to balance. So if you take this idea and apply it to what you've learned this weekend in returns to ledger balancing with your bond, I think that you'll understand that the court, for instance, can't do anything for you until you balance their books with your bond. Then they're shifting the responsibility over to a document, but not to you necessarily, not to you, the human.
Show us.
That's,
Give us an example of that. The lawyers and judge. How do you move a judge into the ledger and give him the bond?
well, I'm not at that particular point from a technical point of view, because I don't have any knowledge of that. Anything I would say would be speculation. But I want you to understand the basic concept that you cannot have anything that goes on in this life, if you want, unless you have a balance. You can buy anything, you can sell anything, but every time you do that, there's a buyer and seller. Now, I'll give you, I didn't bring it, I didn't think about it, but I came across a situation a little while ago where, and I was planning to use this in a court case, but I'd like to avoid the court case. But if I can't avoid the court case, then I'll use this. But a lawyer prepared a document for a client of mine, and it was having to do with his real property. It was like an easement. I'm not sure exactly what it is, because I'm not familiar with all those terms. But my client signed as transferor and transferee. And he transferred something. And he signed, or the transferor was all caps, and he signed as, the normal John Doe, John Doe. Now, I looked at that and I said, there's something interesting happening here. This is the same person. Artificial entity, all right? The same person. If this was Jane Doe, I could say to myself, okay, the male person transferred something to a female person who happened to be a spouse. I could understand that, I could transfer to you, I could transfer to you. That's something we can understand, but can you transfer to yourself? But that was a legal document that the lawyer drew up. So it got me to thinking, is it possible from an income tax point of view to be in a document, the taxpayer, which is the artificial entity, and the human agent / representative? And can you in fact transfer from an artificial entity or a fiction to a live flesh and blood and have your signature as, or an agent of the taxpayer and as yourself? Based on this, you should be able to do that. Does that make sense? Yeah. But CRA is going after me for creating a document which did exactly that. So that should be an interesting court case if I decide to go through with it. So how is it that this lawyer could do something which to me sounds bizarre, and yet CRA is telling me that when I did the same document transferring from a taxpayer to the human, that was a fraud? Either this is a fraud or they're the fraud.
Second one got my vote.
We've got to have a reason for that, though.
From what Winston said, if the lawyer is an officer on the ship, his word is truth. Is that correct? Except when he's lying.
Well, that's only because he's got his fingers crossed behind his back. Well, if
What was being transferred?
it's an easement on real estate or something. I honestly don't know. I have to come in with the document and, yeah, Mike,
So are you saying that by that document they actually transferred some value out of the public into the private?
I don't think so. I think it went from,
Is this permission to do a thing?
it's something like that, yeah.
That's why the RCA is getting after you, because you're doing something different than what that attorney did.
Something within the, but I'm using their particular rules and regulations, their definitions, et cetera, according to their income tax act.
But you're not an attorney.
No, I'm not. And maybe that's the difference.
Yeah, you don't have a license to do what they did.
That's a good point. That's a good point.
The other point is that the all caps is a trustee for the Queen, and you, the human being, acting in that capacity as trustee, have to look after the Queen's interest. And so by taking something from her, in a sense, and giving it to somebody else, that's not really for her benefit. And that's why they're going to slap you on the hand unless you've got a really good reason for why you did something as a trustee for her property, for her person, and gave it to somebody else. That's because I've looked at that and I thought, well, why can't I do this and do that and the other thing?
Yeah.
It's like
No, that's a
I
good
asked
point.
one guy, and it was actually Russ Perisky who was telling me, but hey, you're going to run into some trouble with that because who you were being, and anyways, you got it.
Yeah, I understand that. And I mean, we could have a long conversation and discussion of why I think it's legit and why you may not, et cetera. The point is that, and I think Winston hit it on the nail, the lawyer has a license to do something which within their system is okay, but I don't have that right, even though I may be right morally or ethically or whatever. Now, there was actually no funds transferred because they never went through with that, so there's no cash that actually passed hands. And that might be a moot point. But I'm just trying to illustrate some practical aspects of that. As far as how the courts operate, what they do on their ledger, I really don't know. If I took the time to research and study what the courts would do in terms of their bonds and the bonds that you intend to place and I intend to place, I could probably come up with a theoretical background for that. But I think if you understand the basic concept of double entry bookkeeping, which is really what Winston is referring to, you understand how it has to balance. If it doesn't balance, it falls apart. So they've got to have something. If they're going to give up something, they have to have something in return. So if they get a bond, which they can monetize, just like the bank did, they can then give you something in return.
Set off.
A set-off, you know, your freedom or whatever. Now Winston referred to accrual accounting. Accrual accounting. Accrual accounting, an accrual simply means that you can create a debt before its time. As an example, whenever accountants prepare financial statements for their clients, they calculate approximately what the bill might be. And let's say the bill is anticipated to be $2,000. So on the financial statements, they'll build that in as an expense, even though it hasn't happened, and although there isn't an actual invoice. When there's an invoice, the accrual becomes an account payable. Okay? It becomes an actual legal debt. An accrual is never a debt. This becomes a debt because now there's an invoice, there's an obligation to pay. An accrual simply means we anticipate an expense, and from an accounting point of view, within the rules and regulations of generally accepted accounting principles, we can recognize that particular expense today because it'll become a true liability tomorrow. From that point of view, your material could be considered accrual accounting, but it's slightly different than the double entry bookkeeping system. And within the double entry bookkeeping system, as long as you're working with paper or a computer, you can move figures all over the place as long as they balance. It's really quite easy. This is why a good accountant is worth his weight in salt. I don't like to use gold because, I don't think there's enough money in the world to pay for me. But there's enough salt. Because
Salt is the slave's wage, by the way. That's where salary comes from.
Okay, how about pepper? That's a much better spice. But I'd be sneezing a lot. But anyways, the idea is that in order to effect what you want, we do have the knowledge to juggle the books. Sometimes we have too much knowledge, and guys who are dangerous get to work for Enron and those kind of companies. And those are the largest CA firms in the world, by the way, who do their audits. So you have to figure out, who's really the criminal there. Are there any questions on this aspect? Does that sort of enlighten you a little bit more on how, the system works, in a sense?
Kaz, when you mentioned to monetize the note, like, I mean, just what here has gone for a mortgage at one time or another. When that was monetized, and then they lend me the 100,000, they created the money on my signature?
Absolutely.
So they lent
Well,
me
it
nothing.
didn't exist prior to your signature.
So they lent me nothing.
That's a technical thing. I'm not here to debate that. I'm just telling you that as far as their books are concerned, they balance, and they now have a debt which you signed on.
Yeah.
You came on the train.
So if it created on my signature, then I created the money and they lent me my money. They lent me nothing.
They didn't lend you anything of substance. However, when you go before a judge on your failure to pay the mortgage balance with that argument, he's going to say, did you get your house? Did you not get something? You got to think of a good answer to that.
Kaz, I think one of the little problems is if you look at any of the bank's legal documents, you will not find the word money. Okay, it's just not there because they know there isn't any. And so basically to say that they didn't give you your money, as far as I'm concerned, as far as legal is concerned, that's not the issue, okay?
Yeah,
It
and you're
wasn't there in
absolutely
the
right.
first place.
Because what the banks, if you ever looked at bank financial statements or their advertising, like ING is an example, advertises on television, and you can get a better rate there than you can at your corner grocery bank. They'll say, we have $100 trillion billion in assets. They never tell you that they have the same liability. But it's their assets. Their liability is really irrelevant. And the reason is that if you look at a bank financial statements, you can break it down into the cross. You have your asset here, and these are all the deposits in effect. And promissory notes, and you might have some assets such as buildings and whatever. They can do that now. They weren't able to do it years ago. So they always say, here are our deposits. Here's our strength. All right. Many companies, in fact, begin to do that now. They say we have, $10 million under management. They don't really tell you what the liabilities are, and that's really advertising in its extreme. But on this side here, because between Bank 1 and Bank 2, what they have is a balance, right? So they're never out of balance because they know that what are you going to do with your check? The check they give you through the lawyer is going to go into bank number 2. So even if they were to wipe out anything in between Bank 1 and Bank 2 as a system, their ledger's balanced. This is all temporary stuff, but this is what balances, okay? And that's all they're concerned about.
Perhaps in regard to the argument you were making about not getting any money, perhaps a better argument might be in front of the court would be the bank took no risk. And in commerce, if you take no risk, you have no credibility. So in consequence of that, you say this person can't speak in this matter because they have no credibility before the court. They took no risk.
No, that's a good point. If there's any other points that you want sort of me to go over, you can maybe ask me later or something like that. But if there are no more questions, I hope that has helped a little bit, clarify some points.
Thanks, Kaz.
My pleasure.
So there we have it, guys. Highly recommend Winston's series, which ties into everything we've done with the Advanced Treasury Pack, with the gnosis behind bonds especially. It's very knowledgeable with bonds and insurance, and obviously the set-off, the principal set-off. And, watching those two presentations should have helped put the pieces of the puzzle together. And it's interesting, he was alluding to when signing by accommodation, or PP, which stands for per procuration, okay, which we'll get into in the next chapter on the bills of exchange, as to how we can, start signing on behalf of someone else or for someone else. And that's what that solicitor was ended up doing for that easement or that transfer, when he would have obviously been acting in different capacities, either him as a solicitor and then him on behalf of his trust account or his trust that he's got set up, which is probably in his name too. And that's something that I cracked the code of way back when I issued my bond for car insurance, and I underwrote it via two different variations of my name, of the straw man name. Okay, and obviously that was seen again of kind of doing the same thing, but I was charging that entity with my kind of life force in the form of my sign of nature. Okay, but there's ways that you can do it. Obviously, we went through this in the Advanced Treasury Pack, signing with that liability, that signing PP especially helps you give consent on behalf of that entity but showing to who you're sending it to or forwarding it on to, if you want to, achieve set off or get bills paid, that the Crown must then step in as surety for that entity in order to set off the account, bring everything back to zero, balance the books. Okay, and that's why they send out these presentments, because they want and they know that the straw man is a corporation, and they're hoping that you are going to step up as surety and pay for that with your labor. Okay, when in reality, when you understand this principle of banking, especially when we go through bills of exchange and acceptance, that we can accept it on behalf of that entity, but not be made surety or liable for that on the bill. Okay, but otherwise can use these other entities, such as your surname, okay, as surety, which the Crown owns and can act through as an agent. And these agents will be any one of these offices in government, none more so than either the public trustee or the Treasury or whoever you're dealing with, if you're sending in bonds and working with them that way. Okay, it's quite interesting. And just a note on the accrual accounting, right, which he alluded to towards the end there. The deposit is an asset to the bank under accrual. Okay, but it's also a liability. And so they do not know when the funds will be drawn down or a demand is going to be made. Hence why it's persistently going to be deemed as being accrual accounting. Okay, it's an expense that they anticipate that's going to happen at some point in the future, but they don't know when, but they know it's going to happen. Okay, which is why they have it as both an asset under deposits, but also a liability, because they know that that is what's going to have to be repaid at some point whenever the customer decides to make a demand. However, the banker can do with those funds as he pleases, which is the whole nature behind the banker-customer relationship, which is a special type of debtor or creditor relationship. Okay, so very revealing in this latter stage of this journey, which hopefully, just go over those presentations again and rewatch things, and it should start to make more sense. Okay, so with that being said, let's dive straight into now the notes that I've taken out of the book surrounding accounts. Okay, that's going to tie into this quite nicely. So we have the account, no matter what type, is a means of keeping score. That is, of identifying transactions in a way that shows the amount currently owed by the banker to the customer. In the past, a savings account was usually accompanied by a passbook in which deposits and withdrawals are recorded. The passbook is essentially a copy of the customer's account in the bank's ledger. It is also usual for the passbook to contain the basic terms of the agreement between the banker and customer. These terms are part of the terms of the contract between the bank and its customer. Again, there's a case there. Passbook accounts are no longer being issued by Australian banks. There may be a few legacy passbook accounts opened some years ago and still maintained. Some customers find these accounts convenient methods of saving, but passbook accounts do not offer third-party payment facilities. The usual term of the contract is that the passbook must be presented when withdrawing or depositing funds to the account. UK courts have held that the passbook is evidence of title to the account. Okay, and there's a case there, specifically Birch versus Treasury Solicitors. That's going to be a key point. Okay, later on under the bills of exchange, which I will touch on in a minute. The right to treat all the customer's accounts as a single sum for some purposes is known variously as the right of combination, the right of set-off, the right of consolidation, and erroneously is the exercise of the banker's lien. See Garnett versus McEwen, 1872. So a lot of these cases go way back, okay, these principles of banking under this current system. So do we not have other accounts in the private that can be used for such purposes as the right of set-off, combination, and consolidation? We certainly have. A bank cannot be held liable to the beneficiaries unless it knows that the account is a trust account. And there's the case there. When an account is headed trust account, there is little difficulty in fixing the banker with knowledge that the account is indeed a trust account. The banker may also be liable when the account is not described as a trust account, but where the banker knows or should know that the customer holds some or all of the money in the account on trust. The question is always whether the facts are such that the banker should have been aware that the funds were held in trust. Again, there's this particular case, and we'll read out what the verdict was. So a county treasurer had two accounts at the bank, one of which was headed police account, which is obviously linked to a trust account. The treasurer absconded, and the bank wished to combine his personal account, which was in debit, okay, meaning that he owed the bank money, like an overdraft, with the police account, okay, which was in credit. So the bank tried to appropriate funds from the trust account held within the same bank in order to try and set off the debt that was owed on his private personal account, okay, which goes back into the right of combination, set off, or consolidation. Okay, so the court held that the heading on the account, together with the knowledge that the treasurer was a public official, was sufficient to make it clear to the bank that the account was a trust account. The bank could not combine it with the official's private account. Okay, so on the other hand, the fact that the customer is a stockbroker known to handle other people's money does not oblige the banker to treat the account as a trust account. You've got a case there. The same rule would apply to other professions such as real estate agent, solicitor, or auctioneer, although in these cases, the governing legislation usually requires that the accounts be identified as trust accounts. Important distinction here, again, with solicitors and real estate agents operating in the grey zone when it comes to trusts, which makes sense with what the banks are doing with their off-ledger activities to try and hide the credit creation reality. Note real is royal in Spanish as well, so you guys probably all know by now. So all land is royal land, hence royal estate, real estate, like Real Madrid, okay, the monarch, pillar of control through the line of the kingship, owning all the land, controlling all the land. Apart from knowing that there is a breach of trust, there are, broadly speaking, two other situations in which the banker may be liable to the beneficial owner of the account. The first is when the banker receives a benefit from the trust account, usually a payment or a reduction in an overdraft of the customer, with the knowledge that the benefit is trust property. The second is when the banker knowingly assists in the misappropriation of the trust property, whether the banker receives any direct benefit as a result. The first is often referred to as knowing receipt, and the second is knowing assistance, or more recently, accessory liability. Okay, the legal mechanism through which the banker is held liable is known as a constructive trust. A banker in these circumstances has the same responsibilities as a trustee, which entitles the beneficiary to trace the assets into the banker's hands. Very important point to distinguish the liability of a banker that can be passed through the vehicle of a trust account held with him as a trustee, in which the beneficiary, us, can trace the assets into his hands as if he were a trustee in this regard. So this is termed as a constructive trust. So through a constructive trust, a banker can become a trustee. How does that happen? When the banker knows it is a trust account. Okay, so that's very important bit of knowledge to fully understand and take on board. So the basic principles were established in Barnes versus Addy 1874, where the plaintiff attempted to shift losses to solicitors who advised trustees. Lord Selborne said, strangers are not to be made constructive trustees merely because they act as the agents of trustees in transactions within their legal powers, transactions perhaps of which a court of equity may disapprove, unless those agents receive and become chargeable with some part of the trust property, or unless they assist with knowledge in a dishonest and fraudulent design on the part of the trustees. The reason, as explained by Lord Selborne, is that no one can safely discharge the office of solicitor, of banker, or of agent of any sort to trustees if the principles were disregarded. Okay, so this is golden. As we know, they are dishonest and they do receive commission, as they are all agents of the Crown and commissioned officers who receive commission/benefits when embezzling our estate/trust. None more so than the judge, prosecutor, and court who acts as banker in this constructive trust that is established. So we know that they conspire to subrogate the roles of trustee beneficiaries so they can position themselves to receive the funds. They do this through the straw man, as we know. What's known, all bar licensed attorneys take a 6-week course to help assist in this embezzlement with the secret language and code used in court, etc., and procedures. Likewise, with those government officials who work at the Treasury Reserve Bank who are required to take an oath or affirmation of secrecy when administering these accounts. Every agent who otherwise charges and addresses our strawman is thus assisting in this process of misappropriation of trust property. The benefit of taking office is plunder. Pretty powerful point in case law if you can get your head around this. So the banker can only be liable and be seen as an agent of a trustee if he or she knows the account is a trust account. Through a constructive trust, it makes the agent, the banker in this case, of the trustee of the trust liable as if they were a trustee when seeking remedy for damages if there had been some foul play/breach of trust. So it is conditional upon knowing that the account is a trust account, which should be the case for the SEDICAB trust / foreign settlers trust account, as I said, still up at birth, as well as with the social insurance account, social security account, whatever it's called in your given nation, be the same. A personal account or standard business account would not have the potential for constructive trust, and thus the basic customer/banker relationship will ensue. Okay, but that again could be arguable given the grey area, like I said, the duplicitous nature of the entity itself. The straw man, okay, has been created and the account is kept in trust with trustees who are obviously managing the bankruptcy. Okay, so again, it can extend to maybe even a personal account within that name because it was created out of trust from our birth. So that's just food for thought, speculation. But yeah, it's, like I said, important to differentiate the basic banker-customer relationship, knowing what's going on there, and the trust relationship of account held with the trustees as part of a trust, okay, and how that responsibility of trusteeship can only extend to the banker if the banker knows that it is a trust account, okay, because then all of them are bound to act as per the trust indenture for the benefit of the beneficiaries, okay, but obviously, as we know, they do what they do, kill the beneficiary off, dead lost at sea, and they're basically free to do with that money as they please, without any recompense or obligations to pay out the dividends to us, the beneficiaries. So it's all down to us to, again, go back to that principle, making the demands, making the command, come back to life and putting forth the correct language to unlock the remedy that we seek. So it is said that a banker must exercise a high standard of care when acting as a trustee, a standard which is higher than that of an ordinary trustee. That's in that particular case. Passbooks have been supplanted by bank statements. Okay, thus a statement is evidence of title to the account, given the Birch versus Treasury Solicitor case above. So whenever you receive a statement from a company, that is evidence of your account they are administering, which you can accept for value in return for set-off to close the account / balance the books. But obviously, you must have your bonds in place first in order to unlock that process. So bankruptcy and winding up. The law of bankruptcy is that part of the law which provides for the orderly division of assets among the creditors of individuals under certain circumstances. The law of bankruptcy is wholly a creation of statute. The current governing statute in Australia is the Bankruptcy Act 1966. The early law of bankruptcy was directed at the punishment and imprisonment of defaulting debtors. Contrary to popular opinion, imprisonment was not one of the early methods for dealing with debtors, but rather was originally a means to encourage the debtor to use assets which were not available to the creditor by means of the existing legal processes. Once introduced, imprisonment for debtors who will not pay their debts was quickly extended to imprisonment of those who could not pay their debts. There is no doubt that severe injustices occurred. Effective bankruptcy, upon being adjudicated a bankrupt, the consequences for the debtor and all creditors is dramatic, subject to a few minor exceptions. Okay, all the debtor's property vests immediately in another person who has agreed to act as the registered trustee, or, if there is no such person, in the person known as the official trustee. Furthermore, this includes not only the property which is owned at the time of the adjudication, but any property acquired by the debtor on or after the date of the bankruptcy and before the discharge. Okay, Section 58 of the Bankruptcy Act here in Australia, that's codified. The trustee also acquires all rights and powers to take proceedings with regard to any of the bankrupt's property, again dating from the commencement of the bankruptcy. Okay, so the effect of bankruptcy is so important as it is what we see being administered today, the debtor being the government, and any government-created assets such as the straw man, accounts linked to that, on the public side that is, and any GDP, tax revenue the company makes being the assets, and the international creditors being the IMF, World Bank, et al., who work through their agents such as the central bank, courts and public trustee to ensure all present and future assets are secured in trust for the trustee to adjudicate on behalf of the creditors. Remember, the governments do not create money. They issue bonds to the central banks that then create credit on account through the same process as a retail bank does when buying your promissory note, i.e. reclassifies accounts payable as a customer deposit under liabilities on the balance sheet and moves it off ledger, thus ensuring the government remains in debt and thus owes its pound of flesh through bankruptcy to the creditors. Now remember that an account is otherwise evidence of a debt the banker owes you, the customer, and that debt can only be realised once you make a demand on it. So when we see the national debt, and we know how the banks create money off the back of us signing that promissory note, charging it with our life force, and the government's issuing bonds backed by our security birth certificate, which again represents our life force, to whom does all that money belong? We, the people of prosperity. Okay, they've just done their dirty tricks to subrogate all of us to play the role of debtor. We are the bank, we are the creators, slash creditors of everything down here from which God provides in nature for us to utilize. That includes human and natural resources. We are the original issue of all of it. So as it says above, bankruptcy is the orderly division of assets among the creditors. The people who crack the code of the system get all their ducks in a row, revenues themselves as the creditor in fact, and lays claim to the wealth that is due to be distributed to them, that is held there in trust under bankruptcy. Okay, and that's ultimately redemption. Winding up of a company differs from the bankruptcy of an individual in one final respect. At the termination of the winding up, the company ceases to exist. Winding up of a company is not the only way that financial difficulties may be dealt with. Okay, alternatives include the appointment of a receiver or controller, arrangements and reconstructions of voluntary administration, which is obviously the whole model of what's happening on a macro scale with the governments, as we know. So it is interesting, though, how they have framed this whole structure, as it is not black and white in regards to trust and banking law when defining who is acting as who within the trust and banking structure. Okay, for example, as we covered above, the banks look at the executor and administrators as one and the same when operating accounts and does not become trustee until such time administration of the estate is finished. However, in bankruptcy, there is a trustee which holds all property on behalf of the creditors until such time the business is wound up, and or there are arrangements, reconstructions and administration put in place. A banker can only be seen as acting as trustee if the account clearly states it is a trust account. So when this is known, a constructive trust is established and the banker can be liable, without which the account is simply a chosen action, evidence of debt owed to the customer that has no special relations or liability on behalf of the banker except for fulfilling demands to draw down the debt it owes to the customer and providing payment facilities. I mean, it's still pretty much the same, but it just means that the banker knows that he could be held liable if he's assisting in a breach of trust on the account. It's still like traditional banker customer relationship that offers the same kind of services as what's just been mentioned there. It just means that the bank is more mindful because he realized that he can get sued if he is helping to assist the trustees in misappropriation, all right, and fraud. So there is automatically a high degree for duty of care on that account by the banker when it is known it is a trust account. The basic function of bank and customer relationship is still enforced, and that principle stands, but it comes without a duty and care on behalf of the banker who would, in my guess, treat an order from a beneficiary more favorably than a mere personal business account customer. Thus, a beneficiary would have more leverage when wanting to renegotiate or make demands on the account held in trust, for instance. Okay, because we don't know what the bank is and the account, like who actually owns the account, who the banker is, the Treasury and the IRS do. Okay, so it's a matter of writing to these so-called intermediaries, or the IMF or the Treasury, and or people believe the IRS do too. Okay, so it's just a matter of setting up communications, liaisons, contracts with these folks, so they can then correspond with the ghost account holders on the private side in order to start negotiating the terms and be that middleman, the bridge, go back to the bridge again, the pass-through in order to find your remedy. Okay, which means that you might end up finding out who it is, and then you, like I said, when people get invited in, this whole realm with the private realm will start opening up to the individual. I guarantee it. I've heard enough through the grapevine to know that that's what goes on, and yeah, you'll come out from amongst them, my people. And this is where we'll go into Winston Strout's notes, which kind of alludes to this with the bankruptcy and the cycles of bankruptcy that have happened over the last 210 years, that now the remedy that's provided for us is the ability to leave the bankruptcy, but it's all down to us individually. And this is the whole walk of sovereignty in this age of Aquarius, which is governed by Uranus, which governs sovereignty, independence, innovation, and maverickness. And that's certainly rising these individuals who reconnecting with our higher self down here. So these are some of Winston Strout's notes that I've taken out of those Kelowna series that are surrounding accounts and accounting. Okay, that will just finish off, and then we'll head over and do the bills of exchange in the next chapter, which is again another big subject that ties into all of this, and especially acceptance. Okay, how to accept properly. So Basel III is obviously bringing these off-ledger accounts into transparency so they can be validated. So guys, you can use that and quote that international law, and it'll be codified in domestic act somewhere, wherever you are. Account payables that you can use to maybe subpoena the accounts if the banks aren't willing to play ball and regards to you trying to discharge or set off your mortgage, for instance. Account payable side, they are taken off ledger, which only shows the promissory note. On the accounts receivable side, which shows you as the debtor. In court, they subpoena the account payable on that account to show the book's balance at the time the loan was issued, meaning there was no debt. Okay, money of exchange versus money of account. Then you've got asset accounting versus accrual accounting. Banks are pretty much accrual accounting, like I said, because of that concept. The bank is customer deposit is always a liability to the bank, but they just don't know. They don't know. There's no set schedule or routine when that's going to be paid off. So it's all done by arbitrary demand on that account. So that's how they kind of do the accounting with that. It's under accrual. Conversion, private, okay, public, keeping books at zero balance, that's the only consideration. The big goose egg down at the bottom, that's why in the public it is required to keep records. They cannot execute a contract in the public because you are not doing set-off. Mostly you are doing discharges. Again, this is discharge versus set-off. Discharge always points to the future. 1933, HGL 192, government took substance out of commerce for use. Impossible against public policy to pay a debt. Obliterated common law. Okay, that's based on substance. The public sphere, it is just the adjustment of the accounting, nothing to do with payment. So when you're at court, it is not payment, it is bail. There's a difference, okay? And the whole system is based on just the adjustments of the accounts. So we can't pay, all right? So the only remedy we have is really set off. So contract exists not where it is made, but where it is paid. Under discharge, the contract can never close. All accounts and records can then be reopened in history unless you set off the books. Remedy that was left by the government was to discharge a public debt into the future. The government said we will accept limited liability in all the debts of all the citizens, which meant they accepted the liability for the debts. When you discharge a debt, the government is the future event that promised to pay whenever substance comes back into use in commerce. And I've got a feeling that's probably going to happen quite soon. So I think enough of us is going to end up cracking this code in this next wave of individuals working this out that I'm seeing. Other gurus pop up, people sharing interviews and stuff that, yeah, the consciousness and the understanding of the subject is rising rapidly, which is great to see in a lot of individuals out there. That's helping to pull up the rest of the collective. And once we reach critical mass, the hologram will shift. Okay, and we'll literally pave the way for the new world to be birthed, which will be in favor for we the people, not the few. Okay, under the central planners model of what they want to try and achieve with the whole Freemasonic two-pillar system. Okay, it's going to be under the law of one, but under equity, and it's just going to be like heaven on earth, basically. So I can't wait. So I know it's not far away, and each and every one of us here, it's going to be self a pat on the back, who is obtaining this wisdom, understanding it fully, and then applying it peacefully and honorably on paper, you know, in accordance with being an adept, being responsible. Okay, you're going to help shift it and bring it forward here on earth sooner rather than later. We are the ones we've been waiting for. So set off will adjust the account to zero balance. There is no longer any controversy. It's kind of like this for that. The attorney's job is to keep the controversy rolling. They don't like set off. Okay, trustee has the legal obligation to settle all debts of the trust. Important because, you know, again, we know that they're administering the trust. And who are the trustees? They've got the legal responsibility to pay the debts on behalf of the beneficiary. So courts are there to figure out how to get the books to reflect a corporate profit. Attorney's license gives them insurance/bond, insures their vessel. Whomever writes the insurance policy subrogates the rights and defences of the party for whom they write the policy. Now, it's very key to understand when you get into bonds and what we're doing and what's happening with the bonds and with everything with the art of subrogation, okay? Subrogation transfers the rights to the insurer who issued the insurance policy to act in your place to defend and settle the claim. The liability thus falls on the insurance firm. I mean, it's so obvious if you're in a car. So you go to an insurance firm, okay, you pay a premium, which is the tax, for a policy that the insurance firm agrees that if you're ever in an accident, under the terms and conditions of the policy, which is a trust indenture, that they will be able to subrogate the rights and defences that you have as the claimant so they can step in to make the claim and settle the accounts with the other party. And that's the whole basis of court. Okay, and it's all based on insurance, which is why I highly recommend that you watch the Winston Shrout seminars, because it will help elevate your understanding surrounding insurance and bonds, and why bonds are very powerful, because you're basically giving the holder of that bond, whether it's the Treasury, okay, for instance, for a set-off, the rights and defences to step in for you to cover any claim, okay, which would arise as a result of the conditions in the bond, which would be to set off any debt or any bills or statements that's sent to you. Okay, so you could say, look, well, I've got this policy in place. It's like an insurance policy, basically, this bond. With the Treasury, they didn't rebut after 30 days. So they are now obligated under contract law, silence acquiescence, to step in as my insurer to set off any claims being made against me and this straw man, this entity, or any entities that I control. Okay, so they are then able to subrogate themselves into dealing with the claim and settling the debt on your behalf as pretty much a trustee. Okay, so a similar kind of relationship there when you unlock that process with the insurance and the bonds. So foreign insiders trust set up on the basis of an application, which is obviously the source document or certificate of live birth, whatever it's called where you are. A trust that has nothing in it is not a trust at all. Okay, so trust was funded by actuary models based on value of one's life and deposited. They start leveraging and rolling the money, creating a huge fund. These certificates of live birth were all pulled and put together in a fund, a ghost account. Death exemption for an estate is the same as what is gifted at birth, that is then accrued. Value is deposited by some foreigner, probably the IMF. The title of the trust is, your name and the birth certificate. You can spend your whole life operating from this trust. However, an offer comes along by your country and offered a limited liability insurance for payment of debt, national insurance or social security, wherever you are, whatever it's called, it's all the same. With that is issued a new title and a new number. Okay, the 9 digits demonstrates it's a QSIP number so they can trade internationally. So we have 2 accounts with numbers associated with that account. We've got the social security national insurance account and the birth certificate account, which would be the registration number. Obviously, we all know the number on the social security national insurance, which again is 9 characters. So what did the insurance policy do to the trust? It subrogated it. At the very least, the country took a power of attorney and subrogated the rights and defenses of the birth certificate title, you, to that of the national insurance. Okay, it's a joint venture kind of setup, but now the corporation have access to your foreign insiders trust. Okay, so they swooped in and basically, again, like I said before, stole your crown and the ability to liaise directly with the trustees of your foreign insiders trust. They say, oh no, we'll come and do it on your behalf. Here are the privileges and benefits, here's the terms and conditions, it's all the statutes, acts, la 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 la. Okay, and we'll do all that for you. Don't worry about it. We can access and dip into it and do our appropriation of it, and we'll clandestinely declare you dead on paper, so we don't have to, by law, pay out any dividends or the share of the Commonwealth to you, because you're still dumb in our eyes, because we educate you through the fiction debt-based indoctrination camps, right? And it's only up to you to let us know otherwise and prove to us otherwise that you're not incompetent, illiterate, innumerate, and a ward of the state, like a baby, etc. So you know the spiel. So it's all down to us to change the record, close the public books, and open up a passbook on the private side. All the funds in the foreign insiders trust is in the accrual. Okay, again, like I said, the whole banking is literally accrual accounting, given the concept of how a customer deposit is perceived under law and then accounting practices. SEDK trust, the only thing that can produce wealth is labor, our body/energy. So any value in these trusts relate to us, the contributing beneficiary. So we have the only real claim to any value that is in any one of these trusts, claim of right, claim of life. So only thing that is happening is that you're not making the claim, right? A UCC1, the security agreement, filed on the UCC1, the lien on both trust accounts. When you do that, it secures you to receive all the benefits of the accounts. The birth certificate value is technically unlimited. Washington, DC is an international bank connected to the IMF, connected to the World Bank. Okay, so for those of you in America, you can work with your domestic treasury, but you can also send in to the Washington, DC treasury, which will be international. And then you certainly want to be starting to contract and notify and liaise with the IMF and or the World Bank. So whenever you go from private to public to private, you need some kind of pass-through. That pass-through would be your national insurance or social security account governed by the Treasury. The birth certificate is your remedy in the public to settle the accounts, okay? This is quite interesting. The Constitution, so this goes into the history and what is now afforded to us as remedy, just briefly. So this is America. Constitution was filing for bankruptcy owing to the Articles of Federation, which would then owe into the East India Trading Company, which is King George way back when. 1789, the original bankruptcy of America. Under Anglo rules of bankruptcy for nations, it can only last for 70 years. Okay, so what was the surety then for the first initial bankruptcy? It was the land. In 1859, they had to find the new surety as all other lands had liens on it and they already made surety. So they concocted a new war, which was the Civil War, to capture the freehold land of the South to act as surety for the next 70-year bankruptcy. In 1871, the new corporation formed called United States to assume the debt and liability of the bankruptcy from all companies prior. In 1903, the new corporation could not or would not pay the debt. So in 1913, as a result, they came out with the Federal Reserve Act to deal with the bankruptcy. In 1929, the end of the 70 years, and they created the crash of the stock market to set up the third bankruptcy. Okay, so the 1933 came along, as we all know. The third period of bankruptcy used the people as surety, okay, the movable dirt, voluntary slavery, although done so in ignorance. So after the 70 years of slavery, the debt was paid. So come 1999, people can no longer be held as surety for the debt owed all the way back to East India Trading Company way back when, right, 210 years ago. If the people decided they do not want to operate in bankruptcy anymore, they do not have to do so. Same principle applies the world over, which is why redemption is now available for people to come out of debt and not be bonded in bankruptcy. Okay, so it's up to us. Bonds allow you to instruct the agency/agent you issued the bond to act on your behalf whilst being indemnified up to the value of the bond as stipulated in the bond agreement. Courts deal with accrual accounting. If charged, you can appoint a clerk as fiduciary to settle and close the matter with a copy of the set-off bond you have with the Treasury. All the clerks operate Treasury accounts, okay, because the court, along with all the commercial banks, are there for the purpose of collecting the interest due on the national debt. Accrual accounting, you can create a debt before its time. This is definition. An accrual never becomes a debt until an invoice is received, which then moves it on ledger as an accounts payable. Okay, whereas in reality in the bank, it's still on the accounts payable liability, but it's not made fact until a customer makes a demand to either transact, debit the account, or transfer, etc. Make a withdrawal. So it's a way for accountants to anticipate expenses in the future that will become true liabilities in the future. So accrual accounting for banks is everyone's deposit, which is a liability for the bank, but it is unknown whenever a customer will make a demand to draw on that which is owed. It is always some future date or unknown time unless written to order on a specified date with a check. But for everyday transactions and withdrawals, transfers, it happens instantaneously, on demand or by order, which does not require an invoice to be sent to the bank to access the credits owed to the customer. So no risk, no credibility. The bank took no risk when issuing the loan. So on the day the debt mortgage was created, did the bank balance its books? Did the bank balance its books? Yes, it did. So you can liquidate the mortgage, yes. Where are the funds at? Either at the bank or the attorney has it, one of the two, the obviously off-ledger activities. Anytime in the public, when a public debt has been created, the offset has been created as well and is being held by someone. Since you don't know who that someone is to make the presentment to, this is Winston Trout speaking obviously, let's let IRS figure out who that someone is, because they will liquidate it and zero the account. This is what the whole basis of the Advanced Treasury Pack was, to deal with them and do the final return on that estate. So you're effectively liquidating it and moving into the private. Okay, and because they know a lot of people are copy and pasting it and aren't actually truly understanding what it's doing, the IRS are coming back to people and testing them and trying to, charge them with a frivolous filing charge. So that's all that is just them, again, testing you. Are you copy and pasting, or do you truly know what it is this pack is doing for you and saying? Okay, and I must admit, I did know about 80%. Of what it is trying to achieve, but it's not until obviously going through this banking information and Winston Trout and going back to revisit Bill Turner's work that 20% has been obtained. And so I know now, with the knowledge, that that was a good practice run, the Advanced Treasury Pack. And there's a few things that I would want to amend, and I am going to amend. But standalone, it's still very powerful. But it's now, in this standing, having this knowledge, how to unlock it. Okay, that's a tool. That's a tool now. And you can upgrade that tool if you wish. which is obviously off the back of what's being taught in this more advanced aspect and this under this module. But that's all down to you at the end of the day, okay? And it gets to a point at this level that you must be able to sit down with the templates of everything that's come before and what I've shared to be able to start to formulate and curate and create your own claimants. And again, touch on the logic, ideas, and how you wish to put forth the language in your commands and claims and appropriations and declarations and instruments, etc. Okay. So at this point, it's just a matter of rinse and repeat and accretion. Okay, and just refinement, basically. UCC1 PPSR financing statement shows that you have control of the exemption. That gives you the right to use the thing. Okay, when you obviously file the lien against on the security agreement as well and secure these accounts. Okay, like I said, you've got two main accounts. One is the foreign sellers trust linked to the birth certificate. The other one is the national insurance / social security, wherever you are, trust account. Then you've also got this entity, which is the surname, which is kind of like the non-operating holding company of the Crown, that the Crown can use. Any one of these can be used for any individual to step in as surety to act through, because it's a shell company. All right, and as we get into the next one, you can see how we can sign without liability. That then puts the surety on them to perform, okay, to don the mask, as it were, of our corporate entity, but for our benefit, the real living individual. Deposit account versus reposit account is quite interesting. Public versus private. Okay, bank check is actually a promissory note. Only two parties as the bank, strawman, and endorser, because we're signing as authorized representative, are all the same. This is the whole point. The banks are an extension of our CDKB trust, and our strawman is the bank. So it doesn't matter what corporate bank you're banking with, retail or commercial, they're all one and the same entity. Your strawman, etc. It's all linked to the same account. There's only really two parties on a check. So it's a discharge item. Okay, so the other party is the payee. The one the check is ordered to, so it's actually a discharge item. It's in the future. You can't close escrow on the thing, so it is bundled up and sold as debt instruments. So the promissory note after 6 months turns into a security, which are then used to write bonds. And you've got the private banking is called backroom banking. Okay, bank account for a natural person. They can set up a repository account and bullion accounts. Now, the only reason I share all this is because it's good information to start developing your vernacular now, to have really interesting conversations with even your banker, the Treasury, and the IMF or the IRS, and these agents, these trustees. Okay, who some of them will know because they obviously, like I showed in the analysing the acts here in Queensland, specifically Australia, they have to take an oath of secrecy. And these are the funds and the special funds. That's the private side. That's why they have to take an oath of secrecy of what's going on the private side, which is the side of the phantom ghost account, which is the remedy that we seek of set off and accessing our credits that are owed to us, standing to our credits on an account within a bank somewhere. Okay, banks that we probably not even know about, or unless some of these banks actually have got a private side to them. All right, so there we have it, guys. Again, very educational. Hope you enjoyed that as much as I did. Keep going over it, and it will start embedding and making more sense. And then you'll have the power then to put very powerful pieces of documents together, and commands and bonds, especially, in order to find your remedy. So next presentation, I'll see you over there, and we'll go through and dissect the bills of exchange, which is going to be a big one. But hopefully going to tie off the confusion surrounding acceptance. Okay, we're going to look at the different ways in which that can happen, and what a negotiable instrument is, bills of exchange, and promissory note, and a check. As we just alluded to, check is actually a promissory note. Understanding that concept of what the bank actually is, we, us, and our, it's all the same party. Okay, so thanks for your patience, and I'll see you then. Ciao for now.